In this episode, we are going to answer the question, how can I save paying tax on RMDs? RMDs are required minimum distributions. You can't believe how many Americans are told to do required minimum distributions. The worst advice I've ever heard. Here's how we saved a couple 1.2 million of unnecessary tax. In this episode, you're going to learn how I, as a financial strategist, tax minimization specialist for 47 years, have helped many people, but this particular couple had really saved a lot of money in their IRAs and 401ks. They were both physicians. When they came in, I realized that they had between $5 to $6 million in yet to be taxed IRAs, 401ks, their pension plans and so forth that they had with their SEPs. And so they had been duped, like many people, in my opinion, to sock away money thinking they were going to be in a lower tax bracket when they retired, and lo and behold, they were not. And so they were in as higher tax bracket as they ever were in during their earning years. And they actually came in and said, I don't know how this happened. I'm going, well, you were so busy being physicians. One was an orthopedic surgeon. The other one was a pediatrician. They're busy doing what they do best. And so they just followed the herd and socked away money in these traditional qualified accounts. We'll deal with tax down the road. Well, they could see that coming. And they heard a lot of my videos. They watched them. They read articles. One in particular, Mr. Tax to the Max versus Mrs. I've a Lot More. And they said, well, can you help us? Now, what's interesting is when they first came in, I told them a story before looking at their situation. I said, I had a gentleman that came years ago, and when he came through the seminar, he had $500,000 trapped in his IRAs. And he was 70 and a half. And he knew he had to start taking out RMDs out of his, and his accountant said, oh yeah, just take out the required minimum distribution. And I said, you know what? Hey, you're in the highest bracket and you will never be in a lower bracket. He was like in a 40% bracket. And he went home and he thought about it and he said, why should I even do this over a 5-year period? He actually came back and said, I've done the math, Doug. I'm going to take out my whole $500,000 and pay tax of 40% because I'll never get away with paying less than that rate. I go, that's $200,000. He goes, I know. He pulled out $500,000. He came in with the net of $300,000 after paying the tax of $200,000. He said, now, I don't need this money. I want you to put it into a laser fund to maximize what I leave behind. And he brought in one of his sons. He says, I'm more interested in leaving behind more money to my family than $500,000 in a yet-to-be taxed IRA. Because now under the rules, if he died, and he had already had one stroke, I think, if he left behind that $500,000, his children have to liquidate that amount within 10 years and pay the tax. We took the net of $300,000 and we insured him with his insurance policy for $1.5 million. He died a few years later. We ended up paying tax-free to his family $1.5 million tax-free. Do you think the kids like that better than getting $500,000 in his volatile in-the-market IRAs that they would have been lucky to have netted maybe $300,000 or $350,000? We ended up nearly 5 timesing what he left behind. So when these two physicians came in, here's what I told them. So when I analyzed this couple's situation, I said, you know what? If you continue to postpone and take out RMDs, you're going to probably end up paying over $4 million in tax at a minimum. You're going to pay $2.4 million in tax if you can use all kinds of strategies, keep your real estate mortgaged and so forth. I said, that's more than you need to pay. Now, here is the kicker. When they shared what I was telling them with their CPA, the accountant, and this is not the only time this has happened, the accountant said, they can afford to pay $2.4 million in tax. They have 6 million, but I've never asked anybody, if you could save half of that, would you like to do that? If you could save 10%, everybody says, sure. I couldn't believe it. You wouldn't believe how many times accountants will say they can afford to pay the tax. Well, they don't need to. This is what we did. Over a 5-year period, we started to do a strategic rollout. We're actually doing it even more years, 6, 7, 8 years, because they're earning such good rates of return on their laser fund portfolios. We are transferring money out of their IRAs. We're paying the tax. We're taking the net and putting it into the tax-free laser fund, a portfolio between him and his wife, and that grows tax-free. When they go to take income out of those, and that will be totally tax-free, and when they ultimately pass away, it blossoms in value and reimburses them many-fold the tax they paid getting it out. So their family is not out anything at the end of the day. They're actually ahead of the game, like the little story that I told. Well, during the time that we were taking it out, we paid the tax, put the net in. They've been earning great rates of return, some years way beyond 10% because they use the indexing strategy that I teach in my various books and other episodes. And as we've been getting that out, I've been encouraging them to keep their tax deductions as high as possible. They're savvy, even refinancing their properties or their home or their rental properties and keeping the mortgage deductions as high as possible to offset some of the tax. Now, some people, you've probably watched maybe these episodes where we totally wiped out the tax. I couldn't do that for them. But we reduced the tax from 2.4 million down to 1.2 million. We saved them half. Guess what? They were able to take 1.2 million. What could you do with an extra 1.2 million? Now, some people say, well, golly, they have a lot of money. So 1.2 million in their insurance portfolio, that extra 1.2 million easily generates 100,000 a year of tax-free cash flow in their family bank for their children, their grandchildren, college educations, humanitarian missions, religious missions, on down into perpetuity in what I call a family bank. Why wouldn't you do that? When I give people the choice, they said, oh, I'd rather keep the million in my family to the benefits that I want rather than just rolling it over and paying into more tax in an IRA and stretching it out, and the government uses my money for whatever they want to do. Most people want to be their own fiduciary. They look out for their own best interest. This is one of the stories in my book, The Laser Fund. And if you watch this episode here, this will tell you about this concept in general. They're called strategic rollouts, not rollovers. And I have several examples of how this works, but in the book, The Laser Fund, you'll have an opportunity watching this episode to get a free copy sent to you. You just pay $5.95 shipping and handling. It's over 300 pages, but there are 62 actual client stories like this one I just shared that will blow you away on how the Laser Fund is the dream solution. And one of my favorite strategies is the strategic rollout to get the money out, get the taxes over and done with, reposition tax-free, and offset the taxes by resurrecting deductions when you can do that.